This video will be a review of the skills you'll need to complete the Chapter 4 Tax Return Exam. We're going to be completing Comprehensive Problem 4-1 from your CNOW assignments, going over Form 8949, Schedule D, Schedule E, and of course Schedule 1 in the Form 1040. In this assignment, we have a taxpayer, Theodore Lariat. He's the coach of the Nashville Country Stars soccer team. He's previously coached at different clubs in a different state, so he sold his home before he moved to Nashville. He really has a lot going on tax-wise. He's earned income reported on the W-2. He's got some capital gains transactions that were reported on the 1040 or 1099B, and he also has rental property where we're going to report the income and expenses on Schedule E. So let's get started on the 1040 first. I've filled out the taxpayer's name and social security number and address. He did live in the U.S. for more than half the year and does not wish to contribute to the presidential election campaign. He's filing single and has no digital assets to report. The first thing we're going to do is go over to his W-2 and report his W-2 earnings. Here in box 1, it says that he earned $132,000. So we'll go over to our 1040 and report that on line 1A. He has no other earned income, so we're going to bring that total down to 1Z because there will be nothing else on line 1 to report. Next, let's work on the sale of his home, and we'll go back to the instructions where we'll find all the details. He sold his previous home before moving to Nashville. His only selling expense was a sales commission of $27,500. His basis in the home was $400,800, and he purchased that home on January 5th, 2024, and sold it January 6, 2025. So he held his home for more than a year. For capital gains to be long-term, you must hold the asset for at least 1 year and a day. So this is exactly 1 year and a day. So he can get capital gains treatment from the sale of his home. We can find further details about the sale on the 1099-S, which reports proceeds from the sale of real estate. The 1099-S shows that he sold his home for $557,500. So we're going to first report this sale on the 8949. The 8949 provides detailed amounts, descriptions, and dates for the Schedule D amounts. And at the top of the 8949, like we do on all supplemental schedules, we've entered the taxpayer's name and social security number. Notice that page 1 of the 8949 deals with short-term transactions or capital gains. We know that the sale of his home is a long-term gain. So we're going to go over to page 2. And page 2 also has an area for taxpayer information, so be sure and fill that in. The instructions tell us that we have to check box D, E, F, J, K, or L below because it's telling the IRS where the transaction information was reported. If you remember, it was reported on a 1099-S. So we're going to mark line F, which says that it was a long-term transaction not reported to you on a 1099-B or 1099-DA. DA is for digital assets. So let's go down to line 1 where we're going to enter all our details. Under the description, we're going to enter sale of primary residence. The home was bought on 1/5/2024 and it was sold on 1/6/2025. The proceeds reported on the 1099-S were $557,500. The cost basis was $400,800, and he had selling expenses of $27,500. We'll come back and talk about those selling expenses in just a minute. So here we have next the adjustments to the gain or the loss. So right now he's looking at a $156,700 gain. That's the difference between the proceeds and the basis of the home. Since it's a personal residence, though, an exclusion from that gain is going to apply. A seller who has owned and used a home as his principal residence for at least 2 of the last 5 years before the sale, they can exclude from income up to $250,000 for single taxpayers, and if they're married taxpayers, then $500,000. We know, though, according to the dates here, that he only lived in the home for 1 year. Now, just because he didn't meet the 2-year requirement doesn't mean that he's going to lose the entire exclusion. Since he didn't satisfy the 2-year ownership requirement, he can prorate his exclusion. He can do this because the sale was due to an employment-related move. Remember, he moved to a new job. Therefore, he can exclude some of the gain from the sale. Before we start calculating his exclusion amount, we're going to enter a code from the instructions for the Form 8949 that will let the IRS know the reason for the exclusion. That code is H because it was a sale or exchange of the main home. We're also going to take an additional adjustment for the selling expenses that Theodore paid. So we're going to enter the code E as well to indicate the selling expenses are included in the adjustment. So E for the expenses and H for the sale of the main home. Now let's get to the exclusion amount. Earlier we said that the exclusion for a single taxpayer is $250,000 for 2 years. Since he only lived there for 1 year, that's half the time. So he's only going to get half the exclusion, or $125,000. We're also going to add to the $125,000 the selling expenses of $27,500, which gives us a total adjustment of $152,500. When I enter that on the form, I'm going to make sure to put a minus or put it in parentheses to make sure the IRS knows that it is a deduction. To determine now the gain or loss, we're going to subtract the $400,800 basis from the $557,500 proceeds, and that'll give us a $156,700 gain. And we're going to adjust that by subtracting the $152,500. So our gain is getting reduced down to $4,200. This is our only long-term transaction, so we'll get down to the bottom and enter the totals from above. Just going to bring down the column totals. Now these totals are going to be moved over to the Schedule D. It says enter each total here and include on your Schedule D. So we'll move over to Schedule D and enter the taxpayer and social at the top. We're going to click no, that we did not dispose of any investments in qualified opportunity funds. We're going to skip the short-term section because this is a long-term gain, and we're going to go down to line 10. Remember, on the 8949 we checked box F, so it says totals for all transactions reported on forms 8949 with box F or L checked. So we'll just bring our numbers over. We have other gains to report now, so we're going to go over to the taxpayer's 1099B. Since the basis and the proceeds are reported on the 1099B and all the details, we don't have to report them on the 8949. However, there's no problem if you want to enter those transactions on the 8949 and then bring them over to the Schedule D, but it's just going to be a little bit faster and easier if we can just take them directly to the Schedule D. The broker's statement provides all the information the IRS needs, so we can just simply total up the short-term gains and then the long-term gains and then take them directly to the Schedule D. Both of these transactions at the top are short-term. Notice that the asset was acquired in April of 25 and then sold in December of 25. The SAM-O stock was bought October of 2024 and sold in April of 2025. So we're just going to simply add the totals and report them on line 1 of the Schedule D. If we add the box 1 proceeds, we'll see the total short-term proceeds were $9,000 and the cost would be $8,900 and the net gain or loss would be $100. So let's go over to the D, and on line 1A, notice this is total for all short-term transactions reported on 1099B. So we'll enter the $9,000 as the proceeds, $8,900 as our basis, and then a $100 gain. Since there are no other short-term transactions, we'll bring the gain down to line 7. Now we can go back to the 1099B and pick up those long-term transactions. For Beard Corp, the acquisition date was 2014 and it was sold in 2025, so that's definitely long-term, and this one was purchased in 2020 and sold in 2025. So if we add up the amount of proceeds, that will be $12,900, and then the cost basis will be $17,500, and that's going to give us a net $4,600 loss that we're going to record on our Schedule D. Make that a little larger so you can see it. Going down to the long-term section, on line 8A is the totals for long-term transactions reported on Form 1099B. We'll put the $12,900 in as our proceeds, the $17,500 as our cost basis, and then we're going to enter the loss with a minus $4,600. So once we have that in, that's going to be everything that's going on the Schedule D. So now we're going to total up the long-term section. So the $4,600 loss and the $4,200 gain will give us a $400. That's going to be a net loss minus $400 loss. And then we're going to go right over to part 3 and combine the long-term and the short-term gain, the short-term gain and the long-term loss. When we combine those together, we'll get minus 300. And we'll bring that, this is referring to anything that was a gain. We'll come on down to line 21. If 16 is a loss, enter here and on form 1040, the smaller of our loss, or 3,000. Remember, for long-term loss, you can only take $3,000 a year. So we just have the $300 loss. We're going to come on down and click no for the qualified dividends. So now we're going to go over to our 1040 line 7. And so on line 7, we're going to enter negative 300. Now, Theodore also had interest income reported on the 1099 INT. He had $114. So we'll go back over to the 1040, and on line 2A, enter the $114. Now, Theodore also had rental income that we need to account for. It says that the tenant occupied the home on January 1st, 2025 and pays rent of $1,500 a month. So $1,500 times 12 months in 2025 is $18,000. Theodore required first and last month's rent. So the January rent we've accounted for, but the last month's rent was paid in advance. So we keep up with rental income on a cash basis. So even though the last month's rent has not been earned yet, Theodore has already received it. So we're going to also add that in as income for 2025 because that's when he received that rent. So $1,500 a month plus the $1,500 for the last month's rent. He also got a security deposit of $500. Now, the security deposits are not taken into income. They're just held in escrow and withheld from the tenant upon moving out if necessary. So we're also given his expenses. He had mortgage interest, real estate taxes, insurance. There was no depreciation, repairs, lawn, and other maintenance. It said that Theodore is back in Nashville. He actively manages the rental home. He spends about 10 hours per month on the rental. Okay, so now let's go to Schedule E. Okay, this is where we're going to report the rental income. So the first thing it asks is, did you make any payments in 2025 that would require you to file Form 1099? And we'll say no. We need to enter the physical address of the property, and that was 2300 Bransford Avenue, Nashville, Tennessee 37204. Now we need to describe the type of property. So here is a list to choose from, and this is going to be a single family residence, and it was rented for all 365 days, and there were no personal use days. We decided that the rents received were $1,500 times 12 plus the additional $1,500 for the last month's rent. So that equals $19,500. Cleaning and maintenance was $3,000. Insurance was $3,100. The mortgage interest was $16,000. Repairs $1,000, and taxes were $10,500. There was no depreciation, so if we add all these up, our total expenses will be $33,600. We're going to subtract our total expenses on line 20 from the rents received on line 3. And that is going to give us a loss of $14,100. Now, not all real estate losses or rental real estate losses can be deducted. So we're going to go over and complete Form 8582 to see how much of our loss we can deduct. The IRS puts income into categories, and rental real estate is usually labeled as a passive activity. The reason for this is because the IRS doesn't want people using rental losses to wipe out taxes on their earned income like wages. Sometimes people would just buy rental homes to take a loss so they could offset the regular income. Losses for passive activities are limited to $25,000 usually, but they may be further limited by the income of the taxpayer. And this form is going to help us to determine how much of Theodore's $14,100 loss may be deducted. Okay, so we are going to start with part 1. And we're going to fill out the rental real estate activities section. And we have a net loss, so we're going to start on line 1B. And 1B asks us to go down to part 4 and enter information and bring the amount from column B up here. So we'll go down to part 4 and enter the activity. Rental income, and the loss is $14,100. We'll bring that on over to column E, and now we will bring down the net loss to the total line, and it says to enter this on part 1, lines 1B, and we were working on 1B. So we're going to enter the $14,100 loss there. That's the only loss that we have. So we'll bring that on down to 1D. Let me put that minus because it doesn't have parentheses there. And then we'll bring that on down to line 3. And I'm going to put the minus because it could be income. So the minus will indicate that it's a loss. Now we're going to fill out part 2, which is special allowance for rental real estate activities with active participation, and that's what Theodore had. We're going to enter the smaller of the loss on 1D or line 3, and that is still the $14,100. Enter $150,000. And then enter the modified adjusted gross income. Okay, to do that, we've got to go back over to the 1040 and just add up all the income. So we have 132,000 plus 114 minus 300. And so when we add all that together, the modified adjusted gross income is 131,814. Line 7, it says to subtract 6 from 5, and there we'll get 18,186. Multiply line 7 by 50%, so half of the 18,186 is $9,093, and we're to enter the smaller of line 4 or line 8. So 9,093 is the smaller of the two. On part 3, we're going to enter the total loss allowed. We don't have any income to report, so the total losses will be from adding lines 9 and 10. So that'll be the 993. This is the amount that we can report on Schedule E. So we're going to go back over to Schedule E and start filling out the remainder of that form. On line 22, we're going to bring over the 9,093 that we calculated on the 8582. And then line 23 is just a summary of some of the figures above. On 23A, we're asked to bring down all amounts for line 3. That's our income of $19,500. We don't have anything on line 4. On line 12 is $16,000. There was nothing on line 18. So on line 20, that was our total expenses of $33,600. On line 24, it says to enter the income. We don't have income, so on line 25, we're going to enter our allowed loss from line 22 and from line 21. In our case, it's going to be from 22. And then we're going to just bring this down to line 26. And move that over to, I think that goes on the Schedule 1. Enter on Schedule 1, line 5. So go to Schedule 1, and on line 5, we're going to come down and enter our loss from our rental real estate activity. And make sure you put the taxpayer name and Social Security at the top of the Schedule 1. Okay, there are no other additions to income. So we'll bring the 9093 down to line 10. And we're going to enter that on line 8 of the 1040. Additional income from Schedule 1. Now we can get the total income finally. We'll add 132,000 from 1Z, the 114, subtract the 300, and then subtract the 9,093. So the total income is 122,721. There are no adjustments to income from our Schedule 1. So we'll bring the 122,721 down to 11A and then over to 11B. We know that no one can claim Theodore as a dependent, and he was not born before 1961, nor is he blind. So we're going to enter the standard deduction for a single person on line 12E will be $15,750. Theodore has no additional deductions, so we're just going to bring line 12E total down to line 14, the 15,750. And then on line 15, we're going to enter his taxable income by subtracting the standard deduction from his adjusted gross income of $122,720. And we're going to enter the difference, $106,971. Now that we've got Theodore's taxable income, it's time to calculate his tax. And since his taxable income is higher than $100,000, we're going to have to use the tax schedules to calculate the tax. So he is single, so we're going to use the Schedule X single table. His taxable income is $106,971. That falls between the $103,350 and the $197,300. So I am going to take the taxable income of $106,971 and subtract $103,350. So the excess over the $103,350 is $3,621. That amount is taxed at 24%. So I'm going to multiply that times 24%, and the tax on that $3,000 was $869.04. Now I'm going to add the $869.04 to the $17,651 because this is the tax on the $103,350. They've already calculated for us. So when I add that to the tax that we calculated at the 24%, then the total tax is $18,520. If you have trouble using the tax schedules to calculate taxes, I believe there's a video in Blackboard, or you can contact me and we can walk through a couple of examples, and I think you figure it out. It's pretty simple. So there's no additional taxes, so we'll bring the $18,520 down to line 18 and then on down to line 22, and then down to 24. Now we've got to go back and examine his W-2 to see how much tax was withheld. He had $22,200 withheld from his income. So that's how much he has in prepayments. So from his W-2, we'll enter the $22,200. There are no other additional withholdings, so that's going to come down to line 25D. There are no other payments or credits that we're going to apply to his payments, so his total payment is $22,200. His tax liability is $18,520. So he's paid in more than his liability. So he's overpaid. He's getting a refund of the difference, which is $36.80.